HDFC's earnings call for the current financial year. The Board of Directors at its meeting held earlier today approved the financial results for the year and the quarter ended March 31, 2022, which were subjected to an audit. Over the next few minutes, I will give you a quick summary of the highlights of the performance. As I had mentioned in our earlier earnings call, business during the first half of the year was partially disrupted as a result of the second wave. We, however, saw a sharp recovery in the second half of the year. The third wave in January 2022 saw a rise in infections, but with lesser severity and disruption was minimal. Consequently, we had a strong growth during the quarter ended March 2022. The following were the main highlights of the fourth quarter. RBI has continued to ensure that there is adequate liquidity in the system, and we generally had stable interest rates during the quarter. In the fourth quarter, we have seen a slight uptick in interest rates, consequent to which we have increased deposit rates as well as rates on our non-individual loan products. The inflation trajectory was within the RBI's comfort zone. RBI had on November 12, 2021, issued guidelines on harmonizing NPAs across the financial system. On February 15, 2022, RBI clarified that the applicability of the revised NPA norms will be from September 2022. We have, however, continued to report NPAs under the new norms based on the November 12, 2021.
Ladies and gentlemen, please stay connected. The line for the management dropped.
Hello, Neerav. Neerav, just call it. From here. Just see this.
Ladies and gentlemen, thank you for your patience. We have the line for the management reconnected. Sir, you may go ahead.
Yeah, I'm sorry, there was some technical glitch. So let me start from where I left off. RBI had on November 12, 2021, issued guidelines on harmonizing NPAs across the financial system. On February 15, 2022, RBI clarified that the applicability of the revised NPA norms will be from September 2022. We have, however, continued to report NPAs under the new norms issued on November 12, 2021. Liquidity coverage ratio became applicable from December 1, 2021. This has resulted in higher levels of liquidity carried during the second half of the year. Let me start by quickly summarizing the progress of our business through the quarter. Our individual loan approvals for the year ended March 31, 2022 were higher by 38% compared to the corresponding period in the previous year. For the year ended March 31, 2022, individual loan disbursements grew by 37% over the corresponding period in the previous year. Individual loan disbursements in the fourth quarter were 18% higher compared to the corresponding period in the previous year and were sequentially 21% higher than during the third quarter. Similarly, individual loan approvals were 24% higher than in the corresponding quarter of the previous year. It is important to note here that during the third and fourth quarters of the previous year, we had the reduction in stamp duties in Maharashtra, which had resulted in substantial growth during that period. The month of March 2022 saw the highest monthly individual disbursements ever in HDFC's history at rupees 20,944 crores. Housing disbursements constitute 94% of individual disbursements during the financial year. Growth in home loans was seen in both the affordable housing segment as well as in the middle and high income groups. 91% of new loan applications were received through the digital channels. During the fourth quarter, we sold individual loans aggregating to rupees 8,367 crores. The total loans sold during the year ended March 31, 2022 amounted to rupees 28,455 crores. 99% of these loans were assigned to HDFC Bank pursuant to the mortgage sharing agreement with the bank. Besides individual loans, the corporation also assigned rupees 1,500 crores of standard non-individual loans during the quarter. Individual loan growth on an AUM basis was 17%. If the loans amounting to rupees 28,455 crores had not been sold during the preceding 12 months, then the growth in the individual loan book would have been 25%. Our individual loan book increased to rupees 4,31,533 crores, a growth of 17% over the previous year. In addition to this, the loans securitized by the corporation and outstanding as on March 31, 2022 amounted to rupees 83,880 crores. HDFC continues to service these loans. Individual loans outstanding on an AUM basis amounted to rupees 5,15,433 crores. With regard to the non-individual portfolio, we have seen a pickup in the book during the fourth quarter. We presently have a strong pipeline of construction finance loans as well as in the lease rental discounting segment, and as I had mentioned during the last quarter's earnings call, we have seen a strong Q4 for the non-individual portfolio. As at March 31st, 2022, our non-individual loan book grew by 7% on an AUM basis compared to the previous year and by 6% sequentially from December 2021 to March 2022. The overall loan book is now rupees 5,68,363 crores, a growth of 14%. The total assets under management as at March 31, 2022 amounted to rupees 6,53,902 crores as compared to rupees 5,69,894 crores in the previous year, a growth of 15%. If no loans had been sold during the preceding 12 months, then the growth in the total loan book on an AUM basis would have been 20%. Prepayments on retail loans for the current year on an annualized basis amounted to 10.3% of the opening loan book, which is the same as it was in the previous year. The average size of individual loans for the year ended March 31, 2022 stood at rupees 33 lakhs as compared to rupees 29.5 lakhs in the previous year. The contribution from the higher income group, defined as customers with an annual family income of rupees 18 lakhs or more, has increased during the year to 45% from 40% during FY 2021. Our trust on affordable housing loans continued. During the year ended March 31, 2022, 29% of home loans approved in terms of number of customers and 13% in value terms were to customers from the economically weaker section or the lower income groups. The average home loan to customers in the EWS segment amounted to rupees 11.2 crores and to customers in the LIG segment amounted to rupees 19.7 lakhs. If we break up the loan book outstanding on March 31, 2022 on an AUM basis into different categories, then individual loans constituted 79% of the total loan book as compared to 77% in the previous year. Construction finance constituted 9% of the total loan book. Lease rental discounting loans constituted 7% of the total loan book, while corporate loans constituted 5%. If we were to look at the incremental loan book growth and split that growth between individuals and non-individuals, then for the quarter ended March 31, 2022, the ratio of growth in individual loans versus non-individual loans would be 78% individuals and 22% non-individuals. For the year ended March 31, 2022, the ratio of incremental growth in the loan book would be 88% individuals and 12% non-individuals. So clearly you can see the pickup in the fourth quarter. 98% of the loans were sourced through distribution channels. However, this is largely through HDFC sales, 100% subsidiary of HDFC, and through HDFC Bank. HDFC sales accounted for 52% of the loans sourced, while HDFC Bank accounted for 28%. Third-party DSAs accounted for 18%. Thus, 82% of HDFC's individual business was sourced directly or through our associates. The emergency credit line guarantee scheme was extended to mitigate the economic distress caused by the second wave of the pandemic. Under ECLGS 1, 2, and 3, we have approved an aggregate amount of rupees 2,216 crores, of which 1,747 crores has been disbursed by March 2022. Amounts disbursed under this facility are guaranteed by the central government. The Reserve Bank of India permitted a one-time restructuring of loans under its resolution for COVID-19 related stress. Out of the total restructured loans, just one non-individual account constituted as much as rupees 2,764 crores, and I'm happy to mention that in the last quarter, we have recovered the entire exposure against this account. As of March 31, 2022, the outstanding loans under OTR 1 and OTR 2 amount to rupees 4,572 crores, which is equivalent to 0.80% of the loan book as compared to a peak of 1.4% in September of 2021. 98% of the OTR loans are in the individual loan category. The overall collection efficiency for individual loans has improved significantly in the fourth quarter. The average collection efficiency for individual loans on a cumulative basis, I repeat, this is cumulative basis, over the last quarter is over 99%. RBI had on November 12, 2021, issued guidelines on harmonizing NPAs across the financial system. Subsequently, RBI has deferred the effective date of the applicability of these guidelines to September 2022. We have, however, continued to report NPAs for the quarter ended March 31, 2022, in accordance with the revised RBI circular of November 12, 2021. As of March 31, 2022, calculated under these new norms, gross non-performing individual loans stood at 0.99%, down from 1.44% in December 2021, while gross non-performing non-individual loans stood at rupees 4.76%, down from 5.04% in December 2021. As per the new regulatory norms, the gross non-performing loans as of March 31, 2022 stood at rupees 10,741 crores, equivalent to 1.91% of the loan portfolio, down from 2.32% in December 2021. Based on the earlier method of calculating NPAs prior to the RBI circular, individual NPAs as at 31st March would have been 0.78%, which is 21 basis points lower than under the new method. While total gross non-performing loans in the aggregate would have been 1.74%, which is 17 basis points lower than under the new method. As at March 31st, 2022, we carried a total provision of rupees 13,506 crores. Under Ind AS accounting, both asset classification and provisioning have moved from the incurred loss model to the expected credit loss model. Based on this model, the total exposure at default of rupees 5,67,927 crores is broken up as follows. Stage 1 is 93.3%, Stage 2 is 4.4%, and Stage 3 is 2.3%. So as you can see, we have seen a 2.5 percentage point reduction in the aggregate of Stage 2 and Stage 3 assets from the peak of 9.2% in June 2021 to the current level of 6.7% of the exposure at default in March 2022. During this quarter, we have charged a profit and loss account with a sum of rupees 401 crores towards provisioning. The aggregate charge to the profit and loss account for the year is rupees 1,932 crores. The ECL to EAD coverage ratio for Stage 2 assets is now 20% and for Stage 3 is 54%. The provisions carried as a percentage of the EAD amount now to 2.38%. Annualized credit costs for quarter 4 was 26 basis points compared to 50 basis points during quarter 1, 32 basis points during quarter 2, and 27 basis points during quarter 3. For the year ended 31st March 2022, the total credit cost amounted to 33 basis points, down from 56 basis points in the previous year. As asset quality related issues normalize over time, we should over the next few quarters be in a position to further normalize the credit cost to pre-COVID levels. This in turn will have a positive impact on the return on equity. We continue to hold all our investments in HDFC Bank, HDFC Life, HDFC Asset Management and all other subsidiaries and associate companies at the original cost of acquisition, which is the price we have paid whilst making those investments. These investments are not accounted for on a fair value basis. If we were to mark to market the listed investments as at March 31, 2022, the unrealized gain, which is the difference between the market price on March 31st, 2022 and the carrying cost, would be rupees 2,34,248 crores. This unrecognized gain is not part of our net worth, nor has it been considered in our capital adequacy calculations. Our Tier 1 capital as of March 31, 2022 stood at rupees 98,024 crores. Risk-weighted assets as of that date amounted to rupees 4,41,000 crores. Accordingly, the capital adequacy ratio is 22.8% for Tier 1 and 0.6% for Tier 2. This capital adequacy is well above the regulatory requirement. At this stage, it is important to talk about return on equity. Under the Ind AS accounting requirement, net worth includes certain items which do not form part of Tier 1 capital under the prudential norms. These include Ind AS transition reserve, deferred tax liability on special reserve, fair value gains on investments through OCI, investments in subsidiaries and associates in excess of 10% of net owned funds, securitization gains recognized upfront in accordance with the Ind AS accounting requirement. These items aggregate to rupees 22,227 crores. Hence, Tier 1 capital is rupees 98,024 crores as against a reported net worth of rupees 1,20,251 crores. A more appropriate way of calculating the ROE would therefore be on regulatory Tier 1 capital as against the conventional method of computing it on total net worth. Annualized return on equity on Tier 1 capital for the year ended March 31, 2022 stood at 15%. As at March 31st, 2022, the corporation's total borrowings amounted to rupees 4,88,681 crores. Term loans, including external commercial borrowing and refinance from NHB, accounted for 28% of these borrowings. Market borrowings, that is NCDs and commercial paper, accounted for 40%, while deposits at the end of the quarter amounted to rupees 1,60,900 crores and constituted 32% of the borrowings. 67% of the deposits were onboarded digitally. Before I get to the net interest income, let me outline issues which would have an impact on the NII. In the second half of the current quarter, RBI has introduced a liquidity coverage ratio which needs to be invested in high-quality liquid assets. We therefore have a higher liquidity buffer as compared to the previous year. Secondly, the interest earned on net worth in the current year is lower than the previous year due to lower interest rates. Thirdly, in the current year, the proportion of retail loans has increased from 77% to 79%. Net interest income purely on the basis of interest, without taking cognizance of the profit and sale of loans during the year ended March 31, 2022, amounted to rupees 17,119 crores compared to rupees 14,970 crores in the previous year. The net interest income calculated in a similar manner for the quarter ended March 31, 2022 was rupees 4,601 crores compared to rupees 4,027 crores in the corresponding quarter of the previous year, which is a growth of 14.3%. And this is despite the higher level of liquidity we now carry. The sequential growth in net interest income during the fourth quarter compared to the third quarter was 7%. The sequential growth in the loan book during the same period, which is fourth quarter compared to the third quarter, was 5.4%. Net interest margin for the year ended March 31, 2022 stood at 3.5%, same as in the previous year. The spread on loans over the cost of borrowing for the year stood at 2.29%. The spread on loans during the previous year was a similar 2.29%. Income earned from deployment of surplus funds in cash management schemes of mutual funds and government securities was much lower at rupees 561 crores as compared to rupees 813 crores in the previous year. This was due to average level invested this year in liquid funds at rupees 11,800 crores as compared to rupees 21,700 crores in the previous year, as also due to lower return on liquid funds during the year. There was no profit on sale of investments during the fourth quarter. During this year, the corporation has booked profit on sale of investments amounting to only rupees 263 crores compared to rupees 1,398 crores during the previous year. Under Ind AS accounting standards, the stock options granted to employees are measured at fair value of the options on the date of the grant. This fair value is accounted for as employee compensation cost over the vesting period of the options. Accordingly, employee benefit expenses for the year includes a charge of rupees 390 crores compared to rupees 338 crores during the same period in the previous year. The charge is on account of stock options which were granted during the second quarter of the previous year. For the year ended March 31, 2022, the cost-income ratio stood at 8.1%. For the year ended March 31, 2022, the standalone profit before tax was rupees 17,246 crores compared to rupees 14,815 crores in the previous year, a growth of 16.4%. Tax provision during the year ended March amounted to rupees 3,504 crores compared to rupees 2,788 crores in the previous year. The tax rate for the year was 20.3%. The standalone profit after tax for the year stood at rupees 13,742 crores compared to rupees 12,027 crores in the previous year. For the quarter ended March 31, 2022, the standalone profit before tax was rupees 4,622 crores compared to rupees 3,924 crores during the fourth quarter of the previous year, a growth of 17.8%. The standalone profit after tax for the fourth quarter stood at rupees 3,700 crores compared to rupees 3,180 crores in the fourth quarter of the previous year, representing a growth of 16.4%. Pre-tax return on average assets was 2.9%. Post-tax return on average assets was 2.3%. The basic and diluted earnings per share on a face value of rupees 2 per share was rupees 76.01 and rupees 75.20 respectively. The consolidated profit before tax for the year stood at rupees 28,252 crores as compared to rupees 24,237 crores during the previous year, a growth of 17%. After providing rupees 4,210 crores for tax, the consolidated profit after tax for the period stood at rupees 24,042 crores as compared to rupees 20,488 crores, a 17% increase over the previous year. The profit attributable to the corporation was rupees 22,595 crores as compared to rupees 18,740 crores in the previous year, an increase of 21%. The Board of Directors, after assessing the capital buffers and liquidity levels, have recommended a dividend of rupees 30 per equity share of rupees 2 each, as compared to rupees 23 per share in the previous year. The dividend payout ratio is 39.6%. As at March 31st, 2022, we had a total of 3,599 employees and 97% of our staff has been vaccinated. Total assets per employee stood at rupees 173 crores and net profit per employee stood at rupees 3.8 crores. Let me now spend a few minutes to give you an update on the merger. As you are aware, on April 4th, 2022, the Board of Directors of HDFC Limited and HDFC Bank Limited approved a composite scheme of amalgamation of HDFC with HDFC Bank, subject to requisite approvals from various regulatory and statutory authorities, respective shareholders and creditors. Upon the scheme becoming effective, the subsidiaries and associates of the corporation would become subsidiaries and associates of HDFC Bank. HDFC Bank will then be 100% owned by public shareholders, and existing shareholders of HDFC will own 41% of HDFC Bank. A question which a lot of people ask is why now? We have over the years from time to time evaluated the option of merging HDFC and HDFC Bank. However, in the past we found the cost of a merger to be high and hence did not proceed further. In recent years, however, there has been a series of regulatory changes which now makes the merger extremely attractive. Some of these changes have been as follows. Firstly, the requirement to maintain CRR and SLR has been progressively reduced over the years to a current level of 22%. Secondly, interest rates are lower today, so the negative carry, if any, on meeting any regulatory requirements on liquidity is much lower. Thirdly, RBI now permits banks to hold priority sector lending certificates. These certificates are instruments that enable banks to achieve their priority sector lending targets without actually disbursing the loans. Fourthly, HDFC presently has non-convertible bonds of nearly rupees 90,000 crores, which have an original maturity of over 7 years. Subject to RBI approval, these bonds would qualify as affordable housing bonds and consequently would not carry CRR, SLR or PSL requirement. Fifthly, there has been a harmonization of the regulations governing NBFCs and banks. Consequent to the introduction of the liquidity coverage ratio, we now carry significantly higher levels of liquidity than before. The merger will benefit the shareholders of both HDFC and HDFC Bank as follows. The merger will provide the combined entity with a host of synergies. Lower cost of funds will be made available for the mortgage business. The mortgage business has immense potential and hence the merger will help the group enhance its market share consequent to leveraging on the distribution network of HDFC Bank. The bank will have access to the time-tested mortgage origination and loan servicing processes of HDFC, which have been built up over the last 40+ years. The combined entity will be in a position to enhance operational efficiencies and offer the mortgage product seamlessly as against the current arrangement between HDFC and HDFC Bank, wherein the bank sources mortgages and acquires a predetermined percentage of the loan sourced through the assignment route. As per our estimate, 70% of the customers of HDFC and its subsidiaries do not bank with HDFC Bank, and hence the merger will provide the ability to cross-sell banking products to this large pool of customers. Presently, the bank does not source housing loans from all their branches, but only from those branches which are within close proximity of the HDFC office. Post completion of the merger, progressively, more and more of the branches of HDFC Bank will source housing loans. The merger will enable the delivery of the home loan offering to a large base of over 68 million customers of HDFC Bank in a seamless manner. Today, just 8% of the bank's customers have a mortgage product and just 2% of the customers have a mortgage from HDFC. Also, under the banking structure, the features of a mortgage product can be enhanced in terms of product design, etc. Apart from the synergies mentioned above, the value of HDFC will not be depressed by the holding company discount so far as it relates to the shares of the bank. The unrealized gain on HDFC Bank shares as at March 31st amounted to rupees 1,57,118 crores. HDFC does not get full credit for this, and the market typically applies a holding company discount, which in some cases is as high as 40%. Consequent to the merger, the holding company discount will not be there, and this by itself should add over 62,000 crores to the market capitalization of the combined entity. The holding company discount will go away in as far as it relates to the shares of HDFC Bank. Thirdly, post the effective date, HDFC shareholding of 21% in HDFC Bank will be cancelled. This will open up a potential legroom of over 10% of further holding for FPIs in HDFC Bank. The cancellation will also be EPS accretive for the combined entity. Fourthly, the mortgage product will increase the asset duration of the bank's retail book. HDFC Bank currently has 11% of its assets in mortgages. Post the merger, this percentage is expected to increase to over 30% with the potential to grow much higher. Infusion of capital in the bank will no longer be a drag on the return on equity of the mortgage business. So these were some of the attractions of the merger. The bank has requested RBI for phased compliance in terms of timelines for CRR, SLR and priority sector lending requirements. The bank has also requested RBI to permit the bank to hold equity in the subsidiaries and associate companies of HDFC Limited. These requests are under consideration by RBI. HDFC's distribution network spans 675 outlets, which include 211 offices of HDFC's wholly owned distribution company, HDFC Sales Limited. HDFC covers additional locations through its outreach program. We have continued to engage deeply with all our stakeholders on ESG. Our disclosures and reports are on the website, and for further information on ESG-related queries, you may engage with our investor relations team, Anjali and Conrad. During the year, the corporation's corporate social responsibility activities focus primarily on COVID-19 relief, healthcare, sanitation, education, and livelihoods. Additionally, our support for the specially able cut across all focus areas. CSR activities were conducted either directly or through the H.D. Parekh Foundation. The total CSR spent during the year was rupees 191 crores. These are some of the highlights of the results for the year ended March 31st, 2022 and the quarter ended on that day. Before I conclude, I would like to wish each one of you good health and all the very best. Please stay safe. We may now proceed to question and answers. I would request you to kindly introduce yourself and be as brief as possible with your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Suresh Ganapathy from Macquarie. Please go ahead.
Yeah, hi, Keki. My question is the strategy ahead of the merger. First to begin with, would you like to grow your non-individual book? Now, of course, it's shown some traction in the last couple of quarters. But, ahead of the merger, you still want to focus on this segment because obviously the bank perhaps would like to have a lower proportion. That's question number 1. The other two questions is again related to the issues surrounding it. For example, as per RBI rules, banks cannot borrow from other banks. Term loans are not allowed, and I'm seeing 25% of your entire borrowings is term loans. So what would you do 12 to 18 months down the line, because that is not allowed as per RBI? And the other aspect is your tie-ups with RBL and others. Again, once it goes to the bank, those tie-ups won't be there. Now, that is another 10-15%. I mean, I don't know, the direct selling agents and others put together is 18% of your sourcing. So just wanted to get a clarity on all these three aspects. Thanks, Keki.
All right. So the first one, to answer your question, Suresh, is that the bank recognizes that to do retail individual housing loans, you also need to do construction finance loans. So the activity of giving construction finance loans will continue even in the banking structure.
Okay.
This was question number one.
Yeah.
Your question number three, I think you said, was on borrowings. So we have asked RBI to grandfather the existing balance sheet and grandfather the assets and liabilities. Whenever these liabilities mature, at that point of time, these will have to be replaced by other liabilities.
Okay.
That was the second question. And your third question was tie up with the likes of RBLs and banks, bank structure and other agents. Total loans sourced through all distribution partners other than HDFC Bank and HDFC Sales is 18%. But out of that 18%, the amount which is sourced through RBL Bank is very, very small, extremely small. We can give you the exact percentage in a while. But as far as the other agents are concerned, they can continue to distribute housing loan products for the bank. There is no embargo on agents sourcing asset products for banks, so they would continue.
Okay. And okay, that's very clear. And Keki, one last question is the morale or the motivation of employees ahead of the merger. Obviously, there is a lot of uncertainty. So the next 12 to 18 months, you are confident that the employees will be pretty motivated, because the numbers are pretty good, right? So you have really delivered this particular year despite being a very tough year. So you can expect that to continue in the coming year also?
Yes, we certainly expect that to continue in the current year. And here, when you talk of integration, what you must understand is that unlike the merger of two banks, where both banks will have similar products, both banks will have credit cards, both banks will have personal loans, both banks will have housing loans, and so on and so forth. In our case, that is not the case. There is complete uniqueness in the mortgage product. So HDFC Bank does not directly do housing loans, as you know, and would like to do housing loans because it adds to the duration of their assets. So all of HDFC's employees will be fitted into the bank, will have a major role to play in the bank, and the bank wants to drive the mortgage business going forward. So to my mind, the morale is high. There will obviously be some amount of, people sometimes feel a little uncomfortable when something like this happens. But to my mind, the morale by and large is very, very high.
Okay. Thanks, Keki, for all the answers.
Thank you. The next question is from the line of Maruk Adjania from Edelweiss Financial Service. Please go ahead.
Hello. Congratulations. My first question really is on sector demand. If you see total bank housing loans, and that does not include HFCs, they've grown by 9% year on year when there's so much talk about an uptick in real estate and so many registrations. Of course, the larger players are growing much higher, including yourselves. But why is the overall banking sector demand only at 9%, and how does this augur for future demand? I mean, despite so much rate competition, everyone wants to grow mortgages.
All right. So the answer, Maruk, is that we have grown our individual loan book both on an AUM basis as well as on a net basis by 17% on a very, very large base. As you said, housing loans in the banking system have grown at sub 10%, and that clearly answers the question which I've been repeatedly telling investors, that whilst there is competition in the market, there is no aggressive competition. No one is trying to make you do unreasonable things or give loans at very low interest rates or anything of that sort. So there is competition in the market. It is healthy competition. Now, why the banks are not growing the mortgage book is, I guess, a question the banks itself will have to answer. But to my mind, the structural demand for housing in India is extremely strong. We saw a period from 2017 to 2020 when there was a slowdown in demand in the metro cities. But post-COVID, that demand has also come back. So today we are seeing demand from across the country, whether it is in Tier 1 cities or Tier 2 cities or otherwise, and we expect that growth momentum, that demand will continue in the period ahead. You must also realize one thing, that structurally in India, housing as a product will always grow. And it will grow by virtue of the fact that, as most of you would know, 2/3 of India's population is below 35 years of age, and the average age of a first-time home buyer is about 37 or 38 years. So many of India's population today, so many of India's, the younger people have not even thought of buying a house. But structurally over the next 1, 3, 5, 7, 10, 15 years, all these younger people will get to an age where they will necessarily have to buy a house. And a house gives, the ownership of a house gives the individual that much more security, and therefore, to my mind, structurally, the demand will always remain strong.
Sure, I have a few number-related questions. Firstly, what will be the stock of government securities at March end? Total?
It's about 40,000 crores, approximately.
Okay, and in terms of your total priority sector or your total loans that could qualify as priority sector for the bank as on March, what would that number be?
We have an additional I don't have the exact number with me right now. We can give you the number a little later. But we were carrying an excess stock of priority sector loans which have not been assigned to anyone, where we have not borrowed money from banks against, or we have not sold to the bank. When we saw it some time ago, it was over 25,000 crores. But this is a number which will keep changing, and we will build on that number in due course.
But would that be allowed as priority post-merger, or because of the bonds it won't be allowed? Because you have affordable bonds, right? So it will be lower of the two, or how does it work?
No, both. It qualifies for both. The affordable bonds that you are talking of, which is 7-year bonds, gives you exemption both from CRR, SLR, and if the money is used for doing priority sector loans, it also qualifies for exemption from priority sector requirement. Please read that circular.
Yes. No, my confusion on the circular was that RBI allows 250 billion or 25,000 crores as priority, or just the amount of affordable bonds as priority?
No, the amount raised which has been utilized for doing affordable loans, which would be the full amount. Whatever we borrowed, the 7-year plus bonds of 90,000 crores would entirely have been used in doing affordable housing loans, and the affordable housing loans would be more than that, would be higher than the 90,000 crores that we have borrowed.
Okay. And my last question really is on deposits. I heard the grandfathering reply that you gave. But on deposits, it's a bit more complicated, right? Because the rates on deposits, which if they are allowed grandfathering, would be higher than the rates that HDFC Bank would be offering to its customers. So will that also be allowed?
I mean, the rates are determined by the bank. Whatever rate a customer or a depositor has got money at, that depositor will continue getting the same rate from the bank. Subsequently, upon the deposit maturing, if the depositor wants the deposit to be renewed, which in most probabilities most people renew the deposit, then it will move to whatever rate the bank wishes to offer at that point of time. But the current rate at which the deposit has been taken, that rate will continue.
Okay, thank you so much.
Thank you. The next question is from the line of Shubhranshu Mishra from Systematics Group. Please go ahead.
Hi, sir. Thank you for the opportunity. I have two quick questions. One is that you mentioned about the overlap with the HDFC Bank branches. HDFC Bank presently caters for around 25-26% of the AUM as per the PPT. What is the estimate? Where does it go after the merger? Because you said that a couple of branches don't cater to the HDFC home loans.
No, what I said, if it was not clear, was that all HDFC Bank branches do not source housing loans currently. The reason is that we would like the bank to source loans from locations where we have a nearby office, because we would like to be in touch with the customer, meet the customer, etc., before the loan is given. Now, once we become a merged entity, then obviously that requirement will not be there, and the bank will be able to source loans from all their 6,500 branches over a period of time, naturally.
Right. So, what is the aspirational number as a percentage of AUM? Where do we get to from 20?
Sorry, which number as a percentage of AUM?
HDFC Bank, that's roughly sources around 26-27% of the AUM for us.
Yeah, so HDFC Bank currently sources 28% of the new business that we have done, and they have a right to buy back up to 70% of these loans. So the 70% does not appear in a balance sheet anymore. It would go to the bank. The total loans outstanding which have been sold to the bank is about 83,000 crores. 83,000 crores, I'm sorry. 83,880 crores, if memory serves me right.
Right. And this 28% would go to what kind of the numbers in the future once this merger happens? That's the question that I'm posing.
28% will go to what number over time? Well, I mean, I would not be able to put a number on the table at the moment, but obviously that 28% number has the potential to become significantly higher. Because today the bank is not sourcing loans from all their 6,500 branches, and as they progressively start doing that, that 28% number can become very, very significant.
Sure. The second question is on the yields on home loans, LAP, CF, and...
Your voice is not coming clearly. Maybe you could speak closer to the mic.
Hi, sir. So I wanted to know the yield and the incremental yield on home loans, LAP, LRD, and construction finances.
You want the breakdown?
No, sir. The individual yields on these books, sir, and incremental yields.
Why don't you get all those details later on from Conrad? If you look at the split of our loans, I've already given you. Individual loans constitute 79% of our total loans. Construction finance is 9%. Lease rental discounting loans is 7%, and corporate loans is 5%.
Sure, sir. Thank you.
And if you look at incremental growth, that figure also I mentioned in the call. If we look at the full year, then 88% of our loans were for individuals and 12% were for non-individuals. If we were to look only at the fourth quarter, it was 78% individuals and 22% non-individuals. And you may recall that when we were giving our results in the first quarter, we had mentioned that progressively over a period of the year, the proportion of non-individual loans as the proportion of incremental lending will go higher. So you see in the fourth quarter, it has become 78-22.
Sure, sir. Thank you so much.
Thank you. The next question is from the line of Adarsh from CLSA. Please go ahead.
Yes, hi, sir. Congrats on good numbers. Question on the NII seemed quite strong in this quarter, so just wanted your sense. The NII growth is like close to 8-9%, so and interest rates have kind of headed up on the funding side. So if you could just explain what helped the momentum on NII.
So NII has continued to remain strong. We saw a slight reduction in NII growth during the third quarter because of the higher level of liquidity that we were carrying. We were carrying about 55,000 crores of liquidity at that time. The average level of liquidity during this quarter has been about 46,000. So because the level of liquidity has gone lower, the net interest margin has consequently gone higher. Again, this is something which we had guided for towards when we were giving the December results. So this is one reason. And the other reason is when you talk of interest rates going up, at the end of the day, we do a transaction where we move from a fixed rate to a floating rate. And given the yield curve, we are able to raise money at a lower cost after swapping it into a floating rate.
Got it, sir. And my second question was, when you speak about the disbursements by the bank, just wanted to check, all these disbursements are by the bank's branches, right? So is the bank very actively using its non-bank channels, be it agency and TSAs now, or is that an incremental delta that even that channel of the bank will start sourcing mortgages?
I would guess that channel of the bank will also start sourcing mortgages, and that will also contribute to the overall growth that you would see in the mortgage business. So it's not just the branches of the bank, it will also be the other channels who source asset products for the bank.
Because in mortgages, that will be a large number, right? Because it's secured products, the share of agency versus bank getting business is quite a lot.
Yeah, that's right. So that's also will contribute to the higher growth in the mortgage business.
Got it. So this is helpful. Thanks a lot.
Thank you very much. I request all the participants to be in brief while asking the questions. Next question is from the line of Shweta Daptardar from Elara Capital PLC. Please go ahead.
Congratulations on good set of numbers. So what percentage of HDFC borrowings are linked to external benchmark rates, such as repo, MIBOR or treasury bills?
Well, we match our assets and liabilities in a manner in which the liabilities are linked to certain external benchmarks. There are different external benchmarks that are used. This is part of the treasury operations which are there, and the details you will find in the annual report. Rangan, you want to add anything?
Yeah, just wanted to say that, there are various benchmarks, as you rightly said. In the case of, for example, the bank borrowing, almost 95% of the bank borrowings are actually linked to external benchmark borrowing. And on the debentures and all, as you rightly said, we do conversion of those liabilities into floating rates, and these are again linked to either the treasury bills and those types of benchmarks.
Sure, noted, sir. Thank you.
Thank you. The next question is from the line of Gurpreet Arora from Aviva Life India. Please go ahead.
Yeah, hi. So how do we look at the composition of liabilities for the current year? I mean, what sort of trade paper issuances, what sort of deposit accretions are you looking at? And a related question to that is, what cost of funds are we looking at for this full year, sir?
The source of liability, really speaking, the source of liabilities will keep changing depending on, what is the best at that point in time. But broadly, I think the endeavor would always be as the interest rate curve is currently sort of.
Sorry, I think the line dropped for a bit. Sorry, our line dropped. So please carry on.
Yeah. So as we are looking at the current level of interest rates, I think you basically end up borrowing medium to longer term, and then swapping it back to a appropriate benchmark, so that you can be both on the interest rate as well as on the duration curve. You are on the right part of the balance sheet. So that would be broadly the thing. But in terms of the actual borrowing of how much exactly you will borrow through a debenture or a bond, deposits, bank loans, this would actually depend upon at that point in time what is the best source and the quantum and rates which are available at that point in time.
Please carry on.
Gurpreet, do you have any follow-up question?
No, I'm done. Thank you.
Thank you. The next question is from the line of Subrat from SBI Life Insurance. Please go ahead.
Hi, thanks for taking my question. So this is a follow-up of what was discussed in the previous question about the funding mix. So what I understood was that the funding mix decision would be based on market and not influenced by the pending merger. Is that right?
Yes, absolutely correct. Absolutely correct.
Okay, that's all. Thanks.
Thank you. The next question is from the line of Kunal Thanvi from Banyan Tree Advisors. Please go ahead.
Yeah, hi. Thanks for the opportunity. I had two questions. One was on, we mentioned about the fact that while the overall banking credit, if you see the mortgages, they've been growing at 8-9%. However, when you look at the top, private banks, their mortgage book has been growing at a fast rate, and we also have been growing at a fast rate. Now, how does one interpret into it? Is it, market share gain on the back of balance transfers, or HFCs are growing faster than banks? Because it, kind of makes a confusion in the mind, because the underlying, overall credit is not growing, but the plays within it are growing. Can you explain that to us, please?
It's difficult for me to explain it for why the bank credit is not growing fast enough. My sense is and I do not know, but my sense is that when some of the banks report their mortgage number, they might be including loans which are not strictly housing loans. For example, if you look at certain reports, I've also seen cases where construction finance loans given for residential purposes are included as part of housing, because at the end of the day, it is supposed to be housing finance. But we don't include that. So when RBI, and again this is my interpretation, when RBI prepares this consolidation, they would actually look at only the housing loan numbers, and that would come to whatever that 9% number which is there in public domain.
Sure, got it. And the second question was, on our loan mix prior to merger. I mean, there are three large components. One is the retail or the individual book, then there is a construction finance, and then there is a corporate book. Construction finance, you have given an explanation that, will continue with the, bank coming in. Any sense on the corporate book, which of course is like 5-6% of our book as of, Q4FY22?
That would also continue because the bank also does corporate loans. But as you mentioned, it's not a very large part. It's just 5% of our total lending. But that would continue because the bank does corporate loans in any case.
Sure. Got it. Thank you so much. All the best.
Thank you. Next question is from the line of Abhijit Breval from Motilal Oswal. Please go ahead.
Yes, sir. Thank you for taking the question. So just a small clarification. You report spreads on non-individual loans on a cumulative basis. And I think if I see what is right in front of me, you reported 3.25% as the spread on your non-individual loans as on 9 months, and at the end of this year it's 3.4%. So is this increase that you're seeing in this quarter predominantly coming from that one non-individual account where you have completely kind of resolved it and recovered?
Not entirely, but some bit of it would be because that particular account would have been carrying a lower rate because it was to a customer who was AAA. But there would be other reasons also. There's been a pickup in the construction finance portfolio, which would contribute to a higher yield and so on and so forth. Also, the book itself has really grown a lot in this quarter compared to the earlier quarters. We had a negative 1% growth in the non-individual book till December, and we now have a positive 7% growth.
Right. So, would it then be fair to say that, all the incremental lending that you're doing, which you probably did in 4Q or what you're doing in 1Q now, are happening at rates which are maybe significantly better than the rates at which you were doing non-individual disbursements until now?
At the end of the day, interest rates in the economy by and large have been increasing. As interest rates go up, naturally, the lending rate will also go higher. But the increase is from 3.3 to 3.4 or something. It is not some very significant increase. It can be 10 or 12 basis points or something.
Right. All right, sir. Thank you so much, and wish you the very best for the upcoming month. Thanks a lot.
Thank you. Next question is from the line of Nishin Chawate from Kotak Securities. Please go ahead.
Hi. Just two small questions. Last quarter there was some pressure on margins because of higher liquidity that you were running on the balance sheet. So just wanted to check, has that liquidity come down?
I mentioned that total excess liquidity which we were carrying, or total liquidity that we were carrying last quarter was 55,000 crores, and this quarter the average is 46,000 crores.
Sure. But if I look at the schedules on P&L on the standalone numbers, the other interest and surplus on deployment of liquid instruments, that number has actually grown significantly quarter on quarter from around 736 crores to around 920 crores.
I think we can look at those numbers in detail and maybe Conrad can explain.
Sure, no problem. Just one last data keeping question again was, if you could share the individual disbursement number which you've been sharing for last few quarters for the entire quarter.
Disbursements for the quarter or for the?
For the quarter, because I think you mentioned the number for March.
We'll give it to you. We'll give it to you in a minute. Also, there was a question earlier on how much RBL bank sources for us, and it is comes to 10 basis points. 10 basis points, 0.10%. So not material at all. I think this was Suresh Ganpati's question.
Nischint, the disbursements for this quarter was 48,000 crores.
48,000 crores. Okay. Sure. Thank you very much and all the best.
Thank you. The next question is from the line of Aditya Jain from Citigroup. Please go ahead.
Thank you. The 46,000 crore of average liquidity which was kept in this quarter, would you call this a normal level or is there scope for reducing this further?
Well, it is still higher than what is required by regulation. It's something which we will evaluate from time to time and take a call. But yes, technically there is scope to bring it down a little further. But we might like to internally decide to carry a higher buffer. That's a call which the LM committee will have to take. But it is higher at the moment than what the regulatory requirement is.
Got it. Can you comment on the inward balance transfers now versus historical experience, if it is possible to get a sense of?
So our total prepayments which have been made, which we received during this year, was the same as in the previous year in percentage terms. So it was 10.3% of the opening loan book. And out of the 10.3%, typically, you would find that part prepayments, which is people who want to just reduce their liability, they get a bonus at the end of the year, or they get some lump sum payment at the end of the year, and they sort of reduce their liability. That would normally be about half the total prepayments that we receive. And in the amount of loans we receive versus the amount of loans we've given away would broadly be the same.
Okay, saying inward balance transfers and outward would be roughly equal.
Broadly the same. Yes.
Okay. So effectively, are you saying that inward balance transfers are broadly in line with historical levels? The reason I'm asking is related to the broadly in line.
Yeah, broadly in line, also reflected in the fact that total prepayments have also been similar as a percentage of the book.
Got it. Thank you.
Thank you. Next question is from the line of Rahul Jain from Goldman Sachs. Please go ahead.
Yeah, hi. Gigi, just two questions. One is, if I'm not wrong, I think HDFC Bank had taken some approval to buy back 60,000 crore worth of loan in this financial year, fiscal 23. So would that be applicable now in this event of merger?
So during the current year, I think it's business as usual. So, as you know, the same principles will apply as to whatever they source. They have the option of buying back 70%.
So, Rahul, as you know, the arrangement is that the bank sources loans for us. Yeah. We do the credit appraisal, the legal appraisal, the technical appraisal. We decide whether to lend money to a particular customer or not. If we decide to lend money, we make the disbursement, and then the agreement with the bank is that they have a right to buy back up to 70% of these loans. So you can calculate backwards. We've given you the percentage of loans sourced by the bank. We've given you the total total loans done during the year. You can work backwards and see what 70% of that would be.
Correct. No, I was referring more towards the next 12 months, which is fiscal 23. I think they had taken approval from the shareholders under the AGM to buy back 60,000 crores. Yeah.
You need approval from shareholders. When you take approval from shareholders, this is now a SEBI requirement because it's a related party transaction. You can't calculate an amount. You can't calculate the number. So you always keep a buffer. So you take shareholder approval for a higher amount, and then whatever you actually do, you do. But the actual what gets done will be equivalent to 70% of what they saw. So it is business as usual, Rahul. Nothing changes.
Sure. Appreciate it. The second question is with regards to the liquidity. So, appreciate you ran it down somewhat in this quarter. But given the SLRCR requirement closer to the merger approval or consummation date, let's say, 12 months, 15 months out, will we need to rebuild this liquidity if we need to hold more, or we can continue with the regulation?
We do not believe we will need to build up further liquidity. We do not believe so.
Okay. So at the most we can maintain or we can run it down to the extent possible.
Yeah, accepting that the total amount of liquidity we need to carry, I think, progressively increases by, 10% or something.
Yeah, so Rahul, effective December 22, as of now, our minimum required is 50%. We are around 80% as of March. But by December 22, it will go to 60% and so on, and then 75. So progressively, the minimum requirement goes up.
But we are already carrying more than what the requirement for 2023 would also be. So in that sense, it should not stop.
Fair enough. Just can I squeeze in one last question? So on this restructuring, pardon my ignorance, but I think in this quarter, the recovery of 2,700 crores of one account that you talked about, did it have any impact on the interest income also? Did we recover the entire amount in this quarter? Because I think we recovered somewhat in the previous quarter.
No. The interest would have been accrued from time to time, and whatever was due, including the interest, would have been recovered.
So what would that quantum be in this quarter? Just for this quarter?
Recovered from them, but there's nothing extra which is recovered. Whatever was recoverable up to December would have been accrued up to December. So what you see...
Standard account, KT, so there is no question of...
Okay, it was... Yeah, so there was no stopping of the interest accrual when it turned restructured.
No, it was never an NPA. So...
Yeah.
It was never an NPA. It was always classified as a stage 2 account.
Fair enough. Got it. Appreciate it. Thank you so much.
Thank you. The next question is from the line of Mayank from Citadel LLC. Please go ahead.
Hey, thanks for taking my question. I just had a question on the cost of funds. Now, on a calculated basis, in my model, I see a close to 40 bits decline in your cost of bond funding. My model could be wrong because these are on endpoint averages. So could you just give me a sense on what's been the movement on the bond cost for us at an aggregate?
Rangan, would you be able to answer that?
The reason I'm asking this question is that since you said that most of our bonds are swapped to short-term rates, and short-term rates have moved up in the last 3 to 4 months, I'm just trying to understand
Rangan, you
what
want
we have seen in this quarter and what we'll see going ahead.
Rangan, you want to answer that question on how the rates have come down?
I'll come back on that.
Sure.
So, ma'am, just to give you a quick for the year, if you look at I'm talking of bonds and all market-related borrowings. Last year, the cost, I'm talking of FY21, the cost was around 6.5%. This year, it has been about 5.7%. This is the interest debit for the year based on the portfolio that we are carrying.
Right.
So that's the movement in the cost of the market-related instruments.
And now that short-term rates are moving up, and most of our existing bonds are 70% close to that, maybe is linked to that. Are we likely to start seeing this move up from next year?
I don't believe that there would be any change in the borrowing cost which would not be reflected in terms of a higher yield that we will get. So you would have seen that this morning we have increased the retail prime lending rate by 5 basis points.
And also, Mayank, we have, over the last 4 months, on the non-individual portfolio, we have increased it by 30 basis points, including 10 this morning. So from a spread perspective, we will ensure that we maintain the spreads going.
That also perhaps partly explains the question that somebody else had asked earlier as to why the spread for non-individuals went up from whatever 3.3 to 3.4%.
Got it. If I could just get in one more question. So the 5 bips RPLR change that we have done, should we read this more as a small adjustment, or is this now signaling towards, home loan rates increasing?
No, I would say this is an adjustment. This is an adjustment. It doesn't signify anything. Whilst short-term rates may have gone up a little bit, the 5 basis points that we have done will take care of our requirement in sort of ensuring that the spreads remain stable. Obviously, if rates go up further, then there would be some change. If rates come down further, then there would be all change. But at these levels, we are comfortable.
Got it. Perfect. Thank you so much.
Thank you. Next question is from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Sir, with due regards to all of you, what will be your role along with Deepakji Parekh and other eminent board of directors of HDFC in merged entity?
So as I told you, all employees of HDFC will move to the bank. Specifically, role of Deepak Parekh and me, that is something which the board of HDFC Bank has to take a call on. But all employees of HDFC will move into the bank.
Okay. Thank you. Thank you, sir.
Thank you. The next question is from the line of Sarthak Shah, individual investor. Please go ahead.
Good afternoon, sir. I being an individual investor, just wanted to have a simple calculation as to what would be the ROA of core HDFC business, since I was finding it difficult to calculate.
So the ROA on a pre-tax basis is 2.9%. On a post-tax basis is 2.3%.
Okay, so this is of the core HDFC business, right? Excluding the investment incomes and all those things.
No, sorry. This is on the combined.
So I'm asking of the core ROA.
We can work on that, but I just mentioned the total.
Yeah, I heard that in the introduction. Okay, so can I know the core ROA?
As of now, I would not have that working, but we can talk separately.
Okay, fine.
Why don't you speak to our company secretary, and he will put you in touch with Conrad D'Souza, who's our investment relations.
Okay, yeah. So that's it from my side. Yeah, thank you.
Thank you very much. And I'll hand the conference over to the management for closing comments.
So I would only say that the outlook continues to look very strong. As you would have seen in the fourth quarter, the growth has been strong. NIMs have been, come back. The net interest income is higher than what it was in the third quarter. And most importantly, collection efficiency has further improved during the course of this quarter to the current level of over 99% during this quarter. So at the moment, things look good. And my sense is that the merger is also on track. We are going ahead with all the, discussions, etc., with the regulators. And so far, all the regulators have been extremely supportive and positive. Thank you.
Okay, I have that number, which is the
please go ahead.
bonds adjusted for the swap between December and March. The December number is 570 and the March number is 585.